Now, perhaps you're saying, who is this arrogant shit? He's going to talk about credit analysis when he talks about modeling and all this stuff. Oh, come on. He hasn't been a banker since the early 1990s. What the heck does this guy know? And I think I can maybe add something to you. Because maybe it's because of my old fashionedness and I don't put things in a black box. And I believe this is kind of disastrous to look in a black box. What I'm going to do in this video, and I hope to not make it too long, is discuss how you would look at credit analysis and how you'd use DSCR, PLCR, LLCR, really use them in project finance. And then go to corporate finance and look at some of these ratios that the credit agencies love, like debt to capital, debt to EBITDA, EBITDA to interest, EBITDA to interest, FFO to debt, free cash, operating cash flow to debt, return on capital. That's not good. FFO interest coverage, all of these different ratios, which are all, there's so much multi-collinearity here. They're all totally related. You compute one, you can get the others, at least in terms of there are only three classes of ratios. So we're going to look at that in terms of corporate finance. And I'm going to talk about some ideas on how to look at some of these ratios in corporate finance compared to project finance. And my biggest conclusion, and I'm actually going to start with that. So I'm going to start with a little bit of analysis of corporate finance. And I'm going to say, well, this debt to EBITDA or this FFO to debt or free operating cash flow to debt, they're all very highly, I'm repeating myself, excuse me for that, correlated. But I'm going to show you, if you don't properly account for the lifetime of the assets and how we have to replace the assets, particularly if you use either FFO to debt or debt to EBITDA, if you don't account for them and don't look at these in a meaningful way, the the ratios are totally, can be completely biased and completely wrong. And it's simple mathematics. And I want to show you that if you have to replace your assets every 5 years, 10 years, 15 years, 20 years, you might have long-term assets, the ratio of the debt to EBITDA to get a similar probability of default, to get a similar kind of risk, to get a similar credit standard would be completely different. Remember, these ratios are supposed to help us in terms of measuring the probability of default. So, if we have debt to EBITDA, if we're triple A, this is ancient history, sorry, we have a really low level of debt we can compare to the EBITDA. Now, if you think about yourself and you're trying to explain the debt to EBITDA to your mother, I tried to explain it to my son and he started screaming at me. Oh God, I just spoke like shit. I said, well, look, you have a salary, you have your salary, okay, and then you got to pay some expenses. You got to pay for all your girlfriends, you got to pay for food, you got to pay for electricity, or boyfriends if you're a girl, sorry, and all that. You got to pay for all that stuff, and you might have some expenses. The salary minus your expenses, that's your EBITDA. And let's say, you're better than me. At the end of the month, you're really rich because you're single and all that. You have 2,000 left over. Okay, and then you need your Maserati, and you're gonna borrow 100,000 for your Maserati. So you have 2,000 left for the month, and then I think if I take 2 times 12, I get 24,000. 24,000. And if I make a loan for my Maserati of 100,000, I can take my 100,000 divided by my 2,000. Let's 20,000. I'm rounded at 20,000. Is that okay? So I can pay off my Maserati in 5 years. And that really, for the bank, that might not be good because you really should compare that to the lifetime of this Maserati. And what if I have to start buying more Maseratis and all that later on and get an electric Maserati or something like that? Oh my gosh, then I might have some problems. But that general idea of time to repayment, I take a balance sheet debt divided by a cash flow, EBITDA, and I get it. And then I can say, no, God, that was all stupid because that EBITDA doesn't include the interest I pay and it doesn't include the taxes I pay. And that's why you look at FFO to debt. And for some crazy reason, they don't put debt to FFO and they don't measure it in years. They kind of do it the other way around. And it's the same ratio, except the FFO has taxes and interest taken out. Not that hard, you know. I used to go crazy. Oh, what's this ratio versus that ratio? Oh, gosh. That's the first thing I ever did in 79. I shouldn't have said that. Then we could look at debt to capital. Well, okay, you know, if I value all my assets at what I bought them for and how much, if I had to sell my house and everything else, could I pay off my Maserati? I don't know. How much that debt to capital really works in corporate finance? They kind of look at it. Yeah, of course. If your debt is more than your capital, then you might as well just say goodbye to the bank and just say, take my assets, I'm leaving. Okay. And the final one is EBIT to interest, which is a vague cousin of debt service coverage ratio in corporate finance. We don't pay off the debt in nice, smooth, sculpted increments. We might have a big bond payment. We might grow our business. We might whatever. We pay them all off funny. So we can't really look at EBITDA to debt plus debt service, which is repayment plus interest. We just have to look at it there, and then we get some ratios, and we could look at EBIT. You don't think they're related? Oh, they're obviously related. That takes depreciation and kind of covers a little bit. This EBIT interest coverage would almost be something akin very vaguely to a pre-tax DSCR. Okay, so let's just tell you now. We could look at these ratios and let's just stop with the debt to EBITDA for a minute and say, you know, if it's this high, it's triple C. If it's this high, but that doesn't do anything because we haven't accounted for the risk of the project. So here's what they used to do, and they still do it, but they give you it in a black box and charge you a whole bunch of money. They say, okay, let's give you a score. FFO to debt. They don't use, or debt to EBITDA. This one, if I reverse this around, 1 divided by 30 is, I think, 3.33. Debt to EBITDA is 2. So this is higher than this. And this has to be lower. We have to pay this off in 2 years, 3.3 years after we account for taxes and interest. No taxes and interest here. Okay. I hope I have that all right. And then we give ourselves a score. These are so highly correlated, it's kind of ridiculous to even have two different ratios. And then they give a debt to capital score. And they don't, in this case, they didn't put the debt to EBIT to interest. And then you could compute kind of a weighted score. So let's say we're 3 on all of this. Or let's say we weight each one of them 3, which is really giving 2 times as much weight to debt to capital and FFO to debt. This is taken directly from Standard & Poor's. Let's say we're all 3, for example. We could be 2 here, 3 here, 4 here or something, and take some weighted average or some average. And that gives us our financial profile. So if we're a 3 here, we could be rated A, triple B, or below investment grade. Okay, way above investment grade, kind of a little bit above investment grade, or really bad. And that depends, the same ratio is very, very different depending on if we have this score of being really strong. Oh, you don't want to see that. You have a really safe business, then having a 2 times debt to EBITDA, 3.3 times FFO debt to FFO, only 35% debt to capital. Then we could be rated A. But if we're a really weak kind of company, then even if we have these ratios and we're in some business competing with Amazon or whatever we're doing, then it kind of sucks. And what you can do is basically, I've got examples of this. I put the files with these little old criteria somewhere here on the website. Okay, it's right here. And then you can use a little bit of an interpolate function to get it all working. Okay, but this just doesn't do it. This is what drives me completely kind of crazy when people look at EV to EBITDA or debt to EBITDA in this simplistic way. And I talked about a Maserati, and if we have to replace our Maserati every 3 years, but we can buy a house or something and that lasts 30 years, it lasts a lot longer. We get a very different EBITDA. Let me just show you the result. This is the asset retirements. I should put life. This has the life of the assets. And I'm just going to show you just a little bit. We have some assumptions about what kind of return on invested capital you're making. We have an assumption about how long your assets last. And I'm going to go through all of these. And then I have an assumption about the debt to capital. Maybe I should put the debt to capital a little bit lower. Let's kind of put it somewhere around here. Okay, that's good enough. All right, and I think I probably don't have I have it on automatic. Okay. In this case, if I have an asset that only has 5 years, 5-year life, or even less. I put just 5 years, and that's my company on a weighted average basis. It's got all these assets that have kind of a short life. 57% debt leads to a really, really low EV to EBITDA ratio. I have to be able to cover my EBITDA in less than a year because I have to replace my assets. If I do exactly the same thing, now when I'm running this, it's running a goal seek every single time. So if I put 10 years here, and then 15 years, and then 20 years, and then 30 years, 25 years, 30 years, the exact same company with the same rate of return and this debt to capital percent would result in a debt to EBITDA of 4.4 times instead of that 1.63. And how in the heck can Standard & Poor's and Moody's not recognize this most fundamental kind of idea that you cannot look at a debt to EBITDA for one company with a short asset life and another company with a long asset life and get the same results? That's the point. I got to the point. It took me a tiny bit longer than I wanted to. And I'm going to walk through it. But I'm also, I think I've got to walk through it. Because after this, I'm going to be able to tell you something even better. We're going to be able to say, look, if I have a asset life, and this asset is earning 6% return, and the interest rate, let's make it a 7% return, perhaps. That means, and it gives me kind of a ratio that I need. You might be saying, God, is this bullshit because you haven't told me how you're doing anything yet? Well, I'm going to be able to tell you if you have this asset, the cash flow can go down by 74%. That's a lot. And we still pay off the debt. Maybe it's not so much because and it's got some assumptions in here. And that what that basically says, we're going to go and suddenly we're going to stop. We're going to stop growing, stop making capex. We're just going to run out our assets and kind of switch from project finance to corporate finance. And if I've got a lifetime of 20 whatever 30 years, I can do that. Now if I go downstairs and every time I go it's recomputing, it's really recomputing how many capex I need to sustain my business, and I'm going down to 5 years. And then I'm saying, well, how much can my cash flow go down? And this time my cash flow can't go down as much, even though I have a much lower debt to EBITDA ratio. So you've got to be so careful with the interpretation of these ratios. Now, here's how it works. First, how about if I press Alt U? This is where well, that wasn't very good in that one because it really didn't explain it all that well. Okay, this is what we're doing is first growing the EBITDA by a rate, and then this should have grown by the same rate. So everything I told you in terms of the very specific assumptions was wrong. Okay, excuse me for that. I wonder how many other little things I have like that. So we have some capex to support our EBITDA. And how do I come up with this 77? Well, that's a goal seek. That's a goal seek where we said, okay, I'm going to make my return equal to the target. And the way I'm going to get my return after I hit a stable period, I'm going to have to push it up to 10 years. And after you hit your 10, notice everything becomes all nice and stable. The return comes nice and stable. The debt to EBITDA becomes nice and stable. The interest coverage ratio down here, that becomes nice and stable. This is the beauty of this little kind of proof for corporate finance. And I just haven't seen many other people do it. I don't know why. Okay, and so what I'm doing now, I'm going to show you how it works. So we've got some growth rates, blah, blah, blah. I haven't put those in. We can try different growth rates and see what the effect on this theoretical EV to EBITDA ratio would be for a given debt to capital. Now, later we can even go backwards and say, I'm aiming for a reduction in cash flow. I want to know if the cash flow can go down by 50%, how much debt can I afford, and what happens if I change the life of the asset? Now, the biggest thing, so the next thing I said, oh, okay, let's just throw some working capital in here. And let's say our working capital plus all the other assets, everything, it's not a percent of revenue, it's 40% of the EBITDA. We got a bunch of other little assets we got to make, all of that stuff. Throw that into one thing. And you can do that. You can just go to a financial statement and kind of compute these things. So we have some working capital investment that we started with, and if we grow faster, we're going to make the investment. And then this is the big ratio. Whenever press Alt U here, it says kind of if statement and offset. It kind of gives the ratio. Okay, good. I promised I was going to do that all the time. Now, if I press this button, it just says if we have a 10-year life up here, this is how much we spent 10 years ago, and that is the key behind this. And now you don't get the stable ratios until you get out for 10 years. If you made it for 5 years, you'd get it less. And all this is I'm going to give you the file, obviously, but it's an offset function. You go up and you make a little counter and you say, if I'm going to go backwards, I'm going to go off the sheet. So we can only do this when this offset, when this little counter is greater than the 5, and then we go upstairs to the capex, go backwards 5 years, and that's how we do it. Notice again that the debt to EBITDA is all stabilizing, and all of this, the interest coverage is stabilizing, everything else. If you spend some tiny little time on these corporate finance, I think, making some of these little tables, and that's the only trick you really have to do. And then you say, okay, well, I'm going to just accumulate my plant. Here's how it works. I'm just going to add that. Now, when I add the plant, I put replacement capex, and I shouldn't have, by the way. I'm going to take the last number and I'm going to add the capex. And then, because of accounting, you subtract the accumulated the retirements. This is the assets. They get retired after the years. That's exactly what this stuff does. So we still have to make some capex to continue our company growing, but then we retire our kind of capex. So our net really capex, we this is some to replace it and some to grow. Okay, didn't do that very well. And then we make a depreciation rate on our gross assets. This is the depreciation on gross assets. Shift Control P. And then I'm going to, you always, when you do these kind of exercises, you take the opening balance. Okay, here's our depreciation, and then we accumulate it. When we accumulate the depreciation, this is just accounting. You subtract off the retirements as well. And then you stick in your working capital, and then you have your kind of invested capital. And that's how you start. And that's basically it. You could put deferred taxes, blah, blah, blah. You could put a bunch of other stuff in there. But for this kind of thing, you've got the net assets, which is, I'll call it the invested capital. Okay, and then once we have the invested capital, then we take our EBITDA minus the depreciation. We pay taxes on that. Taxes without considering any interest, and then we have our net operating profit, and then we compute our return as our NOPAT divided by this, and what we need to hit this target. And if I put 10%, I still want to hit that target. Oh, yes, I go out here. Ooh, it scared me. Okay, and what I do up here is to kind of make sure that I've got the ROIC, I put equal lookup. All the time it's lookup. I look up this number, I gotta have a +1 here. And then I say, look, take this one and look in that year and then take that ROIC. That's as easy as it is. And that's how we put the stable debt to EBITDA in and the stable other one. Okay, once you have that, and then you're kind of assuring you're not biasing things by taking one company that has a really high ROIC and another one that doesn't. You can do that. By the way, the biggest kind of crap in here for me is when, where's another one? I've got some more examples, I hope. No, I don't. This one, the thing, if I really thought about credit analysis, what scares me is when they put return on capital. And obviously the return on capital is higher for companies that get you addicted to things, and all that stuff than other companies. Obviously it is. But this kind of return on capital would it would really scare me because it can come down. If there's competition in the industry, it can come down. That's the biggest one. To say, oh, we got a higher return on capital, so we should have a higher credit rating. Where did they do that? Somewhere they put that in as one of their criteria. I would say, no, don't do it. Think. Don't put the black boxes in. And don't say, it's going to always, if it's a fashion industry, it's always going to make these really high returns. Okay, we got to understand whether you've got competitive pressure. Enough of that. And then we put just the debt to capital in, and then we say, okay, well, our debt is just our total invested capital, and the debt percentage of this, it's not really, this is really debt to, well, that's okay. It's debt to invested capital. I think that's okay. And then we compute our debt to EBITDA, which is just the one above, and we get our stable amount down here. That's so cool. It's just amazing, isn't it? And it's the same thing. Now I put an interest rate of the debt on, And then after I put an interest rate on the debt, I say, okay, well, let's compute our interest coverage based on the EBITDA. I should call this EBITDA, interest covered. Okay, and then we got our kind of ratios. And then the final thing I can do is I can say, okay, let's go to this year 10 over here. Did I have it right? Yes, this year 10. And let's grab the EBITDA that we had up here for year 10. I didn't show it way up here. Up here. Here's the EBITDA for year 10. And then we say, okay, well, what happens? I'm going to say this EBITDA is only 32% of the uh, uh, um, the base level we kind of computed to get all this thing going. So it gives me this number. And this is, then I say, okay, well, we're going to stop investing. It's like the pandemic. It makes you kind of think. The airline companies, they just stopped investing. Okay, maybe they don't going to buy new planes. Can we pay off once the pandemic is over? Can we have enough airplane rides, or even before? If people wear masks on the planes and all that, can we for if we have to pay? I hope do I have 10 years here? 11. Whew, how bad I am. It really doesn't matter, does it? Because that's kind of not how I did it anyway. And then I said, well, okay, let's take the difference and let's make a goal seek. Just make a goal seek, and let's see if I want to make this difference equal to 0 by changing the amount the thing can go down. And now obviously what I did is I used the generic macros, and we could afford to go all the way down here and still pay off the debt with this kind of assumption. Okay. Again, this one has a lifetime of 10 years. And this is exactly what that button just did. The debt can go, the cash flow can go down by that much. And then if we, let's do this, exactly the same thing, exactly the same returns. No difference in the growth rates, no difference in the capex, no difference in the taxes, no difference in the debt gearing. And then when we do this, we get a very different debt to EBITDA because we have to make different capex, and this return is geared to the capex. And then I click on this little button. Oh shit! I get about the same thing. Well, that's okay. Actually, that's okay. Let's push it down to 25, and I'll push the button again. It's kind of similar. I kind of like that. And maybe when I did it before, I had some conceptual difference. But we're getting about, for a very different, let me go down to 5. For a very different debt to EBITDA, this, when I went to 5, we gotta lower. That's bad if we can't go down. The good news is the further we can go down, the better. Okay, and that's what. And I'm going to stop here. How am I doing on the time? I think only 28 minutes. A nice short video for me, not boring. Well, you probably got bored stiff. But I hope you see that these target returns are very different. Let's do one more thing. I'm sorry. Let's say let's make another goal seek. And the debt, the way I did this was a little, this is all this crap about that. Well, okay, go from 0 to 100, increment by 5. And I want a target reduction. I want to say a target reduction. Let's say we want to be able to go all the way down by 70%. Let's go down by 40%. Okay. How much, if I And then we will put difference, and it's just a whole lot of goal seeks, really. Let's take this one minus this one. So we can actually go down by 60%. Excuse me for saying that, okay? Or whatever. I don't know what I said. And then we can say, oh, I'm so nervous right now. See, I couldn't make a really short video. I'm sorry about that. We can, if you ever make a goal seek, oh, you'd almost always want to go to the developer and record a macro. Okay, and I'll call this goal seek 4 or something like that, because I have a bunch of goal seeks in there anyway. And then we'll go to a data, and we'll go to what if analysis, and we'll set our goal seek, and we'll set the difference as usual to 0. And then this time I'm going to change the debt to capital ratio. Okay, so if we, oh shoot, I should have stopped the video. Okay, I admit I practiced a little bit here. So here's what we're doing. We're saying, we have this target reduction because we believe there's volatility in the cash flow, and we believe that the probability of having a reduction in EBITDA of 60%, that if we get 40%, that's got a, I don't know, 2% probability, and that would give us the probability of default. That's kind of we're going backwards and saying, okay, it's this business of business risk and all that kind of stuff. Okay, I made it up. We could really, I've got to finish some Monte Carlo videos, but that doesn't really help. We've got to understand the demand response and whether you have a fashion industry that could go out of fashion, all of that stuff. History of other companies. Who knows how you'd get that reduction, but you got a 40% reduction. Now, if I have let's start with a lifetime of 5 years. Now, what I did, okay, and if we have a lifetime of 5 years, again, should be emphasizing every time I change this little button, it does a goal seek and figures out what kind of capex do I have to do to get my target IRR. How much do I have to replace my Maserati? Now, in this case, if I put 40% in, well, I've got EBITDA of 43, which is here's the base EBITDA, and I think that's all okay. So it's that. But if I do a PMT, I didn't tell you, if I do a PMT and I say, okay, what's the amount I'm sorry, this is the amount of debt that's left over in year 6, I hope. Is that right? It's a tiny bit wrong because I should have been taking this 110. Excuse me, I made a little bit of mistake. It's look up this one plus 1. Okay, and then on this one, we take the debt right at the very end. And we have to add a little 1 to this. I should have done it somewhere else. So we have 177 of debt left to pay. We got our equilibrium to be 110. Okay, here. And we go down by 44%. And then we say, okay, let's just pay off the debt and let's pay off the debt using the remaining lifetime of the asset, which is the 5 years in this case, and the interest rate. And that gives us a payment 1, 2, 3, 4, 5. Okay, we can take the NPV of that and make sure that that equals, and it will. Okay, and then we do a goal seek and we say, okay, well, how much, if I want to get exactly 40%, how much debt can I really throw into this company? So I already recorded the macro around here, but we do a what if analysis and go to goal seek and say, let's take that difference between the payment and the. See, I didn't end the video, did I? I promised to end the video and I didn't. Oh, what an ass. And then I change the debt to capital. Okay. And that says with 5 years, here's what I can afford. I can afford only a debt to EBITDA ratio of 1.73. And I can afford to put 62% debt into the capital, and then I need a whopping EBITDA to interest of 11.78. And when I have all those in kind of my base case, I can afford a 60% reduction. That's a pretty good reduction, isn't it? And I can still pay off my debt. Now, of course, you can say, that's not exact, blah, 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 blah. It's all, okay, we can't just stop a company in the middle. We're going to have maintenance, CapEx. You could add a whole bunch of stuff. But the idea is the big deal. And then, so remember, 1.73. Maybe I'll put 1.73. That's our debt to EBITDA. Okay. And then we can also put in the gearing, the debt to cap or debt to invested capital, and that's our 63%. And that's when we have 5 years. Now we should make a data table and make the goal seeks with a data table, which don't work, so you have to make a macro data table and all that. Oh, I gotta take a little breath because now the exciting part. Now let's do the whole thing. And did I put this? I just typed these in, right? Maybe I should also put interest coverage. And the interest coverage is this number. Okay, and now this is with a 5-year life. Now I'm not going to go through all of them. I'm going to go all the way to 30-year life. Okay, now we've got really long-term assets, buildings, utility poles, something like that, water pipes, something like that. That's our biggest asset, and we don't have any trucks or anything else. We just got those. Probably not realistic. So I'm going to put up here to be. I'm going to go from 25 to 30. Now, look at this. We got a big difference. When we used 63% debt, we have a lot of room to go down because our cash flow is here, but we only need 51. And we've already got a higher debt to EBITDA. And now if I do the same sort of thing, and I hope this prompts just a little bit of thought. I made a macro around this, but I'm not going to even bother with it. I'm just going to say, let's take this difference up here, make that equal to 0, and change the debt to capital now. And when I do that, now I get 6.15. This is the real answer. How can Standard & Poor's and Moody's and everybody else say the debt to EBITDA or FFO to debt, blah, 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 whatever multi-corelinearity you have, how can they possibly say that? How can they not directly account for the asset life? I didn't have to do that. And then so we could get this number. It's totally different. It's very industry specific, and we can you get a dramatic difference. It all comes because when you have a Maserati, you have to replace it all the time, and you need to hold back some of that EBITDA you had to replace your Maserati. And if you're just buying a boring old 30-year asset, what do I have to buy this lasts 30 years? I don't know. A lot of stuff lasts a long time. A table. a table, and I'm just going to replace tables. I'm just looking at a table, okay? Yeah, my tables last that long easily. Okay, actually, I have a television that I still am not allowed to use a modern television in my house. Okay, whatever. That's enough. That's enough. Be careful with the financial ratios. Understand how these financial ratios are affected by things. The simplest thing is capex and the lifetime of the asset. And now I'll finally really shut up. Okay, I gotta turn my thing off.